While the public was distracted by the chaotic coverage of the 2026 midterm election cycle and the volatility of the AI-driven NASDAQ correction, something happened inside the municipal chambers of Buckeye, Arizona that alters the math for every dollar in existence. At 2:14 p.m., the city council quietly signed Directive 88 Delta. On the surface, it was a standard infrastructure adjustment. In reality, it was a surrender. The directive didn't just raise rates, it acknowledged a fundamental shift in the hierarchy of survival. For the first time in American history, a municipality formally subordinated the water rights of its 110,000 residents to a priority industrial user, a massive, undisclosed data center complex owned by a subsidiary of a Tier 1 private equity firm. The math was cold. The data center provided liquidity to the city's failing balance sheet. The residents provided only overhead. We are taught to believe that water is a human right, a public utility, a gift of nature. That belief is now a liability. As of this morning, the Colorado River, the lifeblood of 7 states and $1.4 trillion in economic activity, is no longer a river. It is a distressed asset. Inside the walls of the New York Mercantile Exchange and the private boardrooms of Midtown Manhattan, the blue-gold trade has moved from a theoretical hedge to a systemic takeover. While you were watching the price of Bitcoin or the fluctuations in the 10-year Treasury, a select group of resource arbitrageurs was quietly rewriting the laws of property. They aren't buying land. They are buying the rights to the liquid that makes land habitable. In this briefing, we will expose the technical physics of this heist. We will show you how $42.7 billion in private capital has moved into the arid zones of the American West, not to build, but to gatekeep. The era of cheap, accessible water ended while we were looking the other way. This is the Hydro-Hegemony. This is the end of the public commons. The official story is one of noble sacrifice and technological salvation. If you turn on the mainstream financial news, the narrative is polished and professional, and they tell us that the American West is facing a mega drought unseen in 1,200 years. This part is true, but the solution they propose, the visible story, is a carefully constructed mask. The mainstream media presents public-private partnerships, or P3S, as the only way to bridge the $1 trillion infrastructure gap in the U.S. water system. The EPA releases white papers claiming that municipal water systems are crumbling, leaking 2.1 trillion gallons a year due to aged pipes. Cities simply don't have the tax base to fix this, the analysts at the Brookings Institution tell us. Therefore, the story goes, we must welcome the efficiency of the private sector. The narrative emphasizes market-based solutions for climate adaptation. It suggests that by putting a price on water that reflects its true scarcity, we will finally learn to conserve it. Official statements from the Department of the Interior speak of voluntary transfers and collaborative water management. Notice the language used: sustainability, resilience, stewardship. In 2025, the Western Water Security Act was hailed by the New York Times as a landmark achievement in bipartisan cooperation. It provided billions in tax credits for private firms to invest in desalination, wastewater recycling, and smart irrigation. The public was told this would lower their long-term costs and ensure that the taps never ran dry. Even the influencers in ESG, environmental, social, and governance funds joined the chorus. They marketed water ETFs as a way for the average investor to profit while doing good. They showed pictures of thirsty crops being saved by high-tech sensors funded by your 401k. But this visible story ignores the most crucial detail: the transfer of title. While the media focuses on the pipes and the pumps, the hidden hand is focusing on the Prior Appropriation Doctrine. The mainstream explanation treats water like a commodity, similar to corn or oil, which fluctuates based on supply and demand. They want you to believe that if we just price it correctly, the market will solve the shortage. This is a deliberate distraction. Water is not just a commodity, it is a precondition for all other economic activity. By the time the public realizes that pricing water correctly means a 400% increase in monthly utility bills to pay for a private equity firm's 15% IRR, internal rate of return, the legal gates will already be locked. The visible story is about saving water. The hidden reality is about owning the right to exist in the desert. To understand the fraud, you must understand the technical physics of Western water law. In the eastern United States, water law is based on riparian rights. If you live next to a river, you can use it. But in the West, we follow the Prior Appropriation Doctrine. Its motto is, first in time, first in right. If you were the first person to stick a straw into a stream in 1870, you have a senior right. Everyone who came after you has a junior right. In times of drought, the senior rights get 100% of their water before the junior rights get a single drop. This is the mechanism of the heist. Since 2021, a quiet gold rush has been occurring. Firms like Green Square Capital, Water Asset Management, WAM, and subsidiaries of the Big Three asset managers have been identifying distressed agricultural land in the Colorado River Basin. They aren't looking for fertile soil. They are looking for the senior water rights attached to the deed, rights that often date back to the late 19th century. They call this resource arbitrage. Step 1, the acquisition. A private equity fund buys a 5,000-acre alfalfa farm in La Paz County, Arizona for $25 million. To the local community, it looks like a simple real estate transaction. Step 2, the fallowing. The fund stops growing crops, they fallow the land, letting it turn to dust. Step 3, the decoupling. This is the technical trick. They lobby for or exploit existing water transfer laws that allow them to decouple the water rights from the land. Step 4, the monetization. The fund now owns 15,000 acre-feet of senior water rights. They don't sell the water, they lease it back to the nearby growing suburbs, like Scottsdale or Queen Creek, at a massive markup. This is what we call Hydrosecuritization. These water rights are bundled into water strips and sold to institutional investors. Your monthly water bill is no longer payment for a service. It is the yield on a high-risk financial instrument. When your utility company says they need to raise rates to improve infrastructure, what they often mean is they need to cover the skyrocketing lease costs to the private entity that now owns the town's water source. The hidden hand here is the institutionalization of life. In a zero-interest rate world, capital sought yield in tech. In a high-inflation, resource-constrained world, capital seeks inelastic demand. There is no demand more inelastic than thirst. The systemic fragility lies in the Colorado River Compact of 1922. This document divided the river's water based on an abnormally wet period. It allocated more water than actually exists in a normal year. For a century, this paper water didn't matter because the reservoirs, Lake Mead and Lake Powell, were full. But as of 2026, the reservoirs are at dead pool levels. When the physical water disappears, only the seniority matters. The private equity funds have positioned themselves as the senior-most claimants on a dying river. They have effectively shorted the American West climate. They are betting that the drought will worsen because the more scarce the water becomes, the higher the ransom value of their senior rights. Furthermore, the hidden mechanism extends to new technology. Consider the take-or-pay contracts used in private desalination plants. A private firm builds a plant using taxpayer-backed bonds and forces the city to sign a 30-year contract. The city must pay for a set amount of water every month, even if it doesn't need it. If the city finds a cheaper source, it doesn't matter. They are locked into a debt trap designed by McKinsey-trained consultants to ensure that the blue-gold trade remains profitable regardless of the public's needs. This is the physics of the new feudalism. In the old world, the lord owned the land. In the new world, the fund owns the aquifer. You can own your house, you can own your car, but if you don't own the seniority of the liquid in your pipes, you are merely a tenant in a liquidation zone. When a system begins to fail, the regulators do not step in to save the public. They step in to order the liquidation. In 2025, as the Colorado River reached a state of categorical emergency, the federal government introduced the Emergency Water Realignment Act, EWRA. To the casual observer, this looked like the system fighting back, against the privateers. It gave the Secretary of the Interior the power to reallocate water in the interest of national security. But if you read the technical appendices of the EWRA, specifically Section 402, Paragraph 9, you find the systemic patch. The law states that while the government can reallocate water, it must provide fair market compensation to the holders of the rights. This is the ultimate exit strategy for the private equity funds. They bought the water rights for $100 an acre-foot. By declaring a national emergency, the government has trapped the water, but it has also guaranteed the price. The government is effectively using taxpayer dollars to buy back the water from the funds at emergency scarcity prices. It is a massive transfer of wealth from the public treasury to the private balance sheets, disguised as an environmental rescue. This mirrors the 1971 Nixon shock. When the old system of gold-backed currency became untenable, the system didn't collapse. It evolved into a more predatory form. Today, we are seeing the hydrological Nixon shock, the social contract of the 20th century, which guaranteed cheap water to build the American dream, is being torn up. The new contract is market rate survival. Consider the historical anchor of the 1920s land grabs in the Owens Valley, California, the story that inspired the film Chinatown. In that era, the city of Los Angeles secretly bought up water rights to destroy the valley's agriculture and fuel its own expansion. Today, the scale is 1,000 times larger. It's not one city, it's a global network of sovereign wealth funds and institutional aggregators. The system fights back by creating a hierarchy of essential users. Under the new water security framework, households are classified as Tier 3 users. Tier 1 is reserved for critical strategic infrastructure, which happens to include the massive AI data centers and semiconductor plants that are currently receiving hundreds of billions in federal subsidies under the CHIPS Act. The regulators are not patching the cracks to keep the water flowing to your house. They are patching the cracks to ensure that the industrial machine has enough liquid to cool its servers and wash its silicon wafers. If your lawn dies or your shower is restricted to 3 minutes, that is considered a necessary sacrifice for the digital economy. This time, the exit strategy is different from 2008. In 2008, the system saved the banks by printing money. In 2026, the system is saving the capital structure by tokenizing the environment. They are creating a carbon and water credit system. By making water expensive and tradable, they turn a natural limit into a financial opportunity. They have realized that you can print infinite dollars, but you cannot print a single gallon of water. Therefore, the smart money has decided that the dollar is a leaking bucket, and the water right is the only hard floor left. When the system isn't fighting the privateers, it is merging with them to create a state capitalist hydro monopoly. The breaking point will not be a sudden turning off of the taps. The system is too sophisticated for such a crude failure. Instead, it will be a phased dehabitation. The timeline looks like this. Phase 1, the surcharge era, current. Utility bills rise by 15 to 20% annually. The public grumbles, but pays. The water funds use this cash flow to acquire more senior rights. Phase 2, the tiered curtailment, 2026. Cities implement smart meters. If you exceed your biological minimum, the price per gallon jumps by 500%. Meanwhile, the data center next door continues to pull millions of gallons at wholesale strategic rates. Phase 3, the asset-backed migration, 2027. Home values in junior water zones collapse. If your suburb's water lease isn't renewed by the private fund that owns the seniority, your house becomes uninsurable and unmortgageable. The breaking point occurs when the resource arbitrage reaches its logical conclusion. The price of water exceeds the economic utility of the average household. On that day, Day 0, the suburbs of the Sun Belt will face a silent evacuation. People won't leave because of a fire, they will leave because they can no longer afford to flush the toilet. How is smart money positioning itself for this? They are not buying water ETFs, those are for the retail bag holders. The true macro alpha is being found in 3 specific areas. 1. The seniority play Institutional funds are moving into direct title ownership. They are looking for pre-1914 rights in the Sacramento and Colorado basins. These are the AAA rated assets of the hydrological world. In a total systemic collapse, these are the only rights that the courts will protect. 2. The diesel infrastructure arbitrage. Smart money is moving into the chemicals and membranes required for desalination. As the freshwater supply is monopolized, the saltwater conversion industry becomes the new oil and gas. They are positioning themselves to own the refineries of the 21st century. 3. The water-efficient REITs. There is a quiet rotation out of traditional Sunbelt real estate and into hydro-secure jurisdictions, specifically the Great Lakes region. The Midwest Renaissance is not about manufacturing, it's about the Great Lakes Compact, which legally forbids the export of water out of the basin. The 10,000-year supply of fresh water in the Great Lakes is the ultimate long-term hedge. Smart money is shorting the desert and longing the basin. They are moving their capital to where the physics of life are still in their favor. They are selling the sunny lifestyle to the masses while they quietly buy up the rainy future for themselves. The logic is simple. In a world of infinite digital currency, the only thing that matters is what the currency can't buy more of. You can't print a Great Lake, you can't print a snowpack. This is the reality the system cannot admit. We are moving from a carbon economy to a hydrological economy. The transition will be painful, it will be unequal, and it will be final. Here are the 4 structural truths of the Hydro-Hegemony. Truth 1. Scarcity is being engineered. The drought is a physical reality, but the shortage is a financial choice. By prioritizing industrial and speculative users, the system has decided that the average citizen is a low-value consumer. Truth 2. Water is the new basis. Just as the US dollar has been the basis of global trade since 1944, senior water rights are becoming the basis of all physical property value. If you don't own the water, you don't own the land. Truth 3. The public commons is dead. The era of the municipal utility that works for the voter is being replaced by the private utility that works for the shareholder. Your right to water has been converted into a subscription to life. Truth 4. There is no political solution. Both sides of the aisle are heavily invested in the infrastructure P3 model. The emergency acts are not designed to save you. They are designed to provide a liquidity exit for the funds that finance the takeover. And the math of survival is being recalculated in boardrooms you will never enter, using data you will never see. While the world debates the Great Reset as a conspiracy theory, it is happening as a hydrological reality. Prepare accordingly. The tap is no longer yours.